They're about to trap every retail short. Right now, gold is sitting at $4,458, and I can smell the panic. The weekly trend is screaming sell, the daily chart looks like it's falling off a cliff, but the 1 hour chart is whispering something nobody is talking about. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now. This is your instant market verdict. My session bias for gold today is a controlled fade against the lower boundary, but with a hair trigger for a bullish reversal trap. We are effectively range-bound between the gravity of the weekly sell signal and an extremely defined daily support floor. Write this number down. If we break $4,429 on a 4-hour candle close today, the whole structure shifts from orderly decline to an aggressive liquidity grab toward $4,375. That is your invalidation level. Everything above it is short covering territory waiting to explode. Let's go to the charts. I am narrating directly from the screen, so close your other tabs and absorb every price level. We start top down, because that is how institutions see the market. The monthly chart still carries a strong buy signal, and that is the anchor keeping this whole move from becoming a true crash. When you see strong sell on the weekly and strong sell on the daily inside a strong buy monthly, you are inside a classic corrective structure, not a trend reversal. That means deep pullbacks are opportunities until the monthly flips. The weekly chart shows price has sliced below every major dynamic support, the 20, 60, and 100-week moving averages, and is now accelerating toward the 200-week moving average. That MA200 sits at $4,379. Notice that it aligns almost perfectly with our secondary structural support at $4,375. That convergence is not an accident. Institutions will have massive resting bids in that zone. The weekly MACD is firmly bearish, no sign of a crossover, which tells me momentum on this timeframe will take at least another 2 to 3 weeks to bottom unless there is a geopolitical shock. Now zooming into the daily chart. This is where the pain is. Price is below the MA5 at 4,514. Below the MA10 at 4,543, and miles below the MA20 at 4,587. The daily candle structure is a cascading series of lower highs and lower lows. The 20-day moving average is acting like a descending cap, rejecting price on every minor rally. The MACD on the daily is at -42, deeply negative, and the signal line is still pointed down. No divergence here, so the path of least resistance is down. However, the RSI 14 on the daily is at 38, edging toward oversold but not yet at an extreme. That leaves room for one more flush. Here is where the cross-asset linkage with crude oil becomes critical. WTI has been holding a geopolitical bid, supply fear bid, but gold is completely ignoring it. That divergence is a screaming red flag. When oil spikes on geopolitical risk and gold does not follow, it tells you the dominant driver in gold right now is the real yield story, not the fear trade. The dollar is firm, real rates are pinning gold down, and the inflation hedge narrative is on pause. This disconnect means if oil cools by even 2%, gold could get dragged further as the geopolitical premium evaporates. But if oil spikes again, gold may suddenly catch a safe haven bid and squeeze shorts viciously. That is the trap. Now down to the 4-hour and 1-hour charts, where the money is made. The 4-hour trend is still strong sell. Price is hugging the lower Bollinger Band, but look at the hourly chart. The hourly trend is neutral. That is your first clue of exhaustion. On the 1 hour, we have a potential bullish reversal signal forming. The news says gold is stuck below 4,490 resistance with bullish reversal signals on the hourly level. That hourly structure is showing a series of higher lows on the RSI against slightly lower or equal lows in price. Classic positive divergence. The hourly MACD is still negative but curling. If the hourly closes above 4,470, the divergence activates and can drive price rapidly toward the 40 for 90 zone. The daily support is 4,429, a level tested but not broken. Just below 4,375 is the 200-day moving average and structural magnet. Resistances are layered. First minor, the MA5 at 4,514. Then the key intraday pivot 4,543, the MA10. After that the brick wall, the MA20 at 4,587, which coincides with the lower end of the previous value area. Above that, the major resistance is 4,573 and the big figure 4,626. Here is the fundamental driver that changed everything yesterday. The 24-hour core news highlights that the price is stuck below the 40 for 90 resistance, but the hourly chart is coiling. Why? Because the market has fully priced in a hawkish Fed narrative, and now bond yields are stabilizing. The lack of fresh hawkish catalysts is giving gold a chance to breathe. The fundamental narrative web is this: the ECB and BOE are being priced for their own rate paths, which indirectly pressures the dollar, but real yields in the US remain elevated, capping gold. The cross-asset link with the dollar index is paramount. The DXY holding above a critical support is the antagonist for gold. Until the dollar index shows a daily close below its 20-day moving average, gold's upside will be sold into aggressively. My 1 to 2 week directional lean is further downside probing the 200-day moving average, but I want you to watch one event. If the upcoming US PCE data comes in softer than expected, that is the catalyst that invalidates the bearish thesis and can rip gold through 4,600. That is the exact line in the sand. Most people will skip this, but this is where money is made. Keep watching. We are going into 3 precise trade setups. No theory, just actionable levels. Strategy 1, the sniper, conservative. This is for the trader who wants high probability and is willing to wait. The trigger condition is a 4-hour candle close above 4,515. That confirms the 5-period MA reclaim and signals the hourly divergence has momentum. You do not enter market order. You wait for a 15-minute pullback to the 4,490 zone after the close. Your stop loss sits at 4,465. Just below the recent swing low and below the hourly value area low. Your logic is that if price reverses back below the MA5 after a reclaim, the trap has failed and sellers retain control. Target 1 is 4,573, the daily resistance, giving you a risk-reward of 1 to 2.2. Target 2 is 4,620, risk-reward of 1 to 4. This setup is void if the entry trigger does not occur before the New York close, or if price first breaks below 4,429. Strategy 2, the active trader, standard. This exploits the mean reversion tendency inside a range. Entry condition, a push to the 200-day moving average at 4,380, and a strong rejection candle on the 1-hour chart, a bullish pin bar or engulfing candle closing back above 4,390. Your stop loss is at 4,365, just below the wick low. Reasoning, if the 200-day average fails, there is no support until 4,300. Target 1 is 4,460, the recent consolidation breakdown point, and target 2 is 4,540, the MA10 on the daily. Once target 1 is hit, move the stop to break-even and trail by the 1-hour MA10 closing basis. This is a high likelihood bounce trade given the institutional positioning around the 200-day. Let's see how aligned we are. Type your gold range for tomorrow in the comments now. I'm reading them. Is it 4,400 to 4,500? Or are you looking for the breakdown? Drop it below. Strategy 3, the aggressor, high risk. This is a counter-trend long against the daily and weekly momentum, solely for traders who know how to lose small and manage risk aggressively. The entry condition is a false breakdown below 4,429. You watch the 5-minute chart. If price breaks below 4,428, traps the breakdown sellers, and then reverses back above 4,435 within 10 minutes, you enter long with a tight stop at 4,420. Your target is the MA5 area at 4,510, with a partial at 4,470. Risk-reward is skewed at 1 to 3 plus. The invalidation is any 5-minute close below 4,425. This is a trap play, pure and simple. Only for those who accept that a stop run could happen in seconds. Never risk more than 1 to 2% per trade. No positions through high-impact news events like US GDP or PCE releases. Stops are non-negotiable. A disciplined trader survives to trade the next trap. Let's close this out. The single most critical level for the next session is 4,429. That is the daily support that, if broken on volume, opens the floodgates to 4,375. Tomorrow I am focusing squarely on the US dollar index and S&P 500 liquidity tide, because their movement will either confirm gold's breakdown or spark a violent reversal. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan, subscribe and hit the bell for daily coverage. I'll see you in the next one.